This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we take a look at what it takes to keep London workers happy as the work-from-home debate continues.
Plus, will PayPal double company revenue expectations in 2023?
But first, ESG, climate-based investing, those are all the rages going forward, and arguably that's where all the trillions of dollars is actually going. So what does it mean for the hedge fund guys and the private equity guys, and for companies like a KKR and Brookfield that are acquiring some specialists in this area? For more, we're joined by Bloomberg Intelligence senior private equity and hedge fund analyst Gaurav Patankar. Gaurav, how much of a focus? Is it ESG? Is it just the E? Where is the focus here for these kind of hedge fund private equity guys?
That's a great question. The way this has worked is the climate private equity is perhaps the rare bright spot in the private equity space where capital raising has been really effective for asset managers over the last 12 to 18 months, when it's just been very, very difficult in pretty much every other area. Perhaps the E and the S has worked really well here because there's been a lot of emphasis on doing it right by the environment and social. So I think that is definitely one, but I think the private equity managers have been very clever in raising capital and then going towards deploying that capital while the deal landscape has been becoming more and more and more attractive. Because ultimately, when you raise a lot of capital, you want to deliver the returns 3, 4, 5 years out to raise your next fund. And they have kind of set that thing right in this instance.
Well, ESG, I kind of feel like, maybe I'm wrong here, that the momentum is slowing for the attractiveness of ESG, asset flows, things like that. But you're suggesting in the private equity space that's not the case?
Again, Paul, that's a great question. And without delving into the ESG or the political debate there, what I would say is there definitely seems to be a debate about ESG. Having said that, what we are seeing today is a little bit backward looking, right? What we are seeing as the fundraising success of private equity managers is with a 12-month lens. The good part is they were very clever in going out in the market and raising that capital when it was available. So I don't know what happens from here, but for now, they have a lot of dry powder and the deal activity is very interesting.
Are they all chasing the same things?
That's a very good question. If you see the capital raising activity over the last year, about 2/3 of it has been in real assets. So yes, in a way, they're chasing the same things. But those are also the most attractive opportunities available globally, i.e. the infrastructure, transportation infrastructure. All of these opportunities and the deal volume, the deal valuations have become more and more attractive. So I think the ability to deploy against that opportunity is as good perhaps as it ever has been. So yes, they're chasing the same things, but I think there's enough juice in those markets.
In terms of the PE players out there, who are the leaders? Who's kind of getting some of the good deals?
So clearly Brookfield has been heads and shoulders above a lot of people in really raising capital and really focusing on real assets. They zoned in on real assets at the right time, raised a ton of capital, and in many ways, they have gone after deployment when the valuations became more attractive. They're really playing to their playbook here. But most importantly now, we are seeing that Brookfield is followed by KKR and a couple of other well-known private equity names. But now the key thing is talent in the space is narrow. It's a pretty nascent space. So talent is not quite easily available. So the talent wars have just begun.
Where in the world are the deals happening? Because you kind of pair this, the fundraising and the quest for talent with deals, and then you look at, say, the IRA, the Inflation Reduction Act, Europe clearly playing catch up to that. Where's the deal volume going to be?
It's a beautiful little chart. We have it on our note here. We see
like
that
shameless plugs. We like them.
Thank you. Now, it's Europe and U.S. pretty much even. Europe's a little bit in the lead, about 35% market share of total deals, followed by the U.S. And Asia is actually not far behind either with 25%. So it's a really well-distributed wagon wheel globally.
So you mentioned talent's at a premium here. Historically, the private equity industry just sources its talent right off of Wall Street. Wall Street trains them up, whether they're analysts or associates, and they pluck them right to private equity. Where do you get talent for ESG? It seems like such a nascent industry.
Well, let's talk more specifically about climate private equity. It's exactly the same play script. Wall Street has been creating and building and nurturing talent. So believe it or not, Credit Suisse has this rare bright spot where they have the best producing desk on climate private equity or climate deals. And Goldman Sachs, for example, lost someone to KKR. So the talent wars definitely are, basically right around Wall Street, but the buy side is plucking off of the sell side. A traditional play script.
It's like a win for Credit Suisse. I'll take it. What are the returns like for these kind of deals when money is actually put to work? Do we really, truly know yet?
That's a $1 trillion question, right? I mean, we will, like with anything in private equity, we will know the real story only 5, 7, 10 years from here. So for now, it looks very attractive. The entry points are more attractive today than they were 18 or 24 months ago. Should that translate into, double-digit, stable, steady returns over a 7-year cycle? It definitely seems like, but who knows? We'll know in the future.
Knows. It's going to be really interesting. Gaurav, thanks a lot. Gaurav Patankar. He's Bloomberg Intelligence Senior Private Equity and Hedge Fund Analyst.
All right, let's turn now to London, where workers are considering how much it will take to keep them on the job if work from home is denied completely. For more, we're joined by Bloomberg Intelligence Senior Property Analyst Sue Munden. Sue, I've been seeing some reporting that a lot of people around the world, but this one was particularly about London, they're like, we're not coming back. We like this remote work thing. What does that mean for property owners in the UK?
Well, it means quite a lot. We decided to ask employees what their view was about working from home, because obviously, as you say, we get lots in the news about what the employers are saying. We also get lots of information from the really big REITs, but the companies that occupy that space tend to be the multinationals, whereas actually in London, over 90% of businesses are small businesses employing 50 people. So we commissioned a survey to ask employees what their view was, and the results are quite provocative. At the moment, 95% of office workers in London are offered some flexible working arrangements. But 73% of our respondents, and we had 500 respondents, said that they would rather quit their job than be forced to come into the office every day.
Wow.
And then we asked them, wow, it's a lot. It's 3/4 of the population. And actually, we did the survey in June as well and had a similar result. But obviously, we've moved, in June, everyone was still having to work from home because there were, just the remnants of lockdowns and things, and we hadn't really got ourselves back to work properly yet. But since then, you would have thought there may be some change, and actually it's just edged up to 95% of people are offered flexible working, and it's about exactly the same number, but a much tighter variance through the age groups.
So is there anything that would make these workers come back, like a 20% salary increase?
We asked our respondents, the 500 respondents, what it would take to come back to the office full time. And of the 73% that said that they would quit, they said, well, we'll change our mind. 64% said they changed their mind if they got more than 11% salary bump. So yes, they would definitely reconsider, I think.
Or another way to think about it, Sue, is maybe some subsidy for commuting, because even we experienced that, and it was really, really helpful as an incentive. Do companies think about that as maybe a different way to account for costs?
Well, certainly we asked the respondents what are the factors that what they want to work from home for, and transportation cost was 65%. The commute itself was over 50% of respondents said that was responsible for wanting to be at home. And on the factors that would encourage them to work, 60% of them said a salary increase would be great, please. So, the commute, the work-life balance, some said higher productivity at home. Some said they would like to be in the office because of knowledge sharing, for networking, and also some said that productivity was better in the office. So, I think that was more balanced, that particular productivity point.
I do have to say, if it got really cold and energy prices went up really high, I wonder if people would reconsider coming into the office. But side note, you're the real estate senior industry analyst. What does this mean for commercial real estate?
Well, for commercial real estate at the moment in London, which is obviously what sort of spurred the idea for the survey in the first place, we've got vacancy now running at about 10% for central London, the city, the space between the city and the West End, Canary Wharf. that's a huge amount of vacancy. And we ask the question, which of your employees is downsizing, upsizing, moving to co-working? And it turns out that 25% have downsized since June, or are planning to downsize. Another 18% said that they've moved to co-working. So that's sort of 3% have gone smaller offices. And in the context of the fact that leases in London typically are for 10 to 15 years, so it's really difficult to get out of your lease, to have 43% mobility amongst employers during that period is really quite staggering. So this is changing really fast, much faster than I would have anticipated, because before I thought, well, it's going to be a slow process because we've got average 7-year leases of 10 to 15, and it's just as those leases come up, the employers will change their plans, but it doesn't seem that's the case at all.
Sue, thank you so much. We appreciate it. Sue Munden, Bloomberg Intelligence Senior Property Analyst.
Coming up on the program, could slashing bank bonuses affect Connecticut's credit? We'll find out.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
If investment bank bonuses decline as projected and job cuts continue, Connecticut and the local credits it supports may face a backlash. For more on this, we're joined by Bloomberg Intelligence Senior U.S. Municipal Strategist Eric Kazatsky. So, Eric, talk to us about this metro area, New York, New Jersey, Connecticut, really tied in large part to financial services. And they're having a tough time here. Talk to us about the ripple effect for the muni market.
Yeah, absolutely. So, look, the numbers that we're seeing are coming from Johnson Associates, and they're forecasting banker bonuses, across Wall Street to fall on average up to 45%. Pretty big number. The good thing about municipal credits is that they work on a very long lag. So, for instance, Connecticut is just about to do their budget. They're still using last year's numbers where sales tax collections and income tax collections were really good. So the issue that this is really going to impact, you're talking next fiscal year, and that's really where you want to be sort of like putting your chips as far as softening credit when it comes to the municipal landscape.
So how many municipalities depend on all this juicy revenue from Connecticut?
Well, you have like 10 or 12 cities who really depend on the state as far as getting their disproportionate share of income of more of like 50% or more. So you're talking about lower rated entities like Hartford, who the state had to actually come in and help, Wyndham, New Haven, and Stafford, Connecticut, among others.
Wall Street is up and down, up and down. We've seen it before, but it does affect so many surrounding areas to the industry here. What percentage of kind of a lot of the tax revenue for, say, a Connecticut, do you think is kind of derived from financial services?
If you're talking about the Greenwich area,
yeah,
probably a upwards of 60 to 70% is coming in and supporting that metro area. Obviously, as you sort of like expand that radius, it gets less and less. But, New York City in general, as things improve or sort of decline for New York City, it impacts a large region, not just in the New York City metro area, but also into New Jersey as well. The latest numbers that we've seen is that the impact of work from home alone is going to cost the New York City metro economy almost $12 billion. That's a huge amount that they just have no way of making up currently in this economy.
Well, about making it up, and this applies to New York City now and maybe Connecticut, say, then in 2024, how does this stuff work? Like, can you make it up, or is it like a permanent shortfall? $12 billion is some serious money, and that's just on the subway.
Yeah. Well, it's not just from the subway. You're talking about, ancillary spending in the local economy in New York City, lower rents, lower transit rides, all those things sort of feed into that 12 billion number. But, you talk about like how long they have to make it up. The good thing about, state and even like local economies is that they have a lot of different levers that they can pull as far as raising taxes. And, one of the things that's beautiful about, muni bonds in general is that, a lot of these issuers, they don't have a choice. And the taxpayers in those areas don't have a choice but to deal with higher taxes if that's what's needed to pay those bonds. Obviously, like politically unsavory, no one's happy about that, especially if the economy is slowing down. But it's definitely something that they have the power and willingness to do.
So how have municipal bonds for, this tri-state area, how have they performed over the last several years here? Because it just seems like, as you mentioned, subway ridership's down. Will it come back?
Yeah.
Office occupancy is down, particularly Monday and Friday. Will it come back? How have the bonds generally performed?
shockingly well. Let's put it that way. Head-scratchingly well. And I think a lot of that has to do with the fact that there just hasn't been a ton of primary, new issue supply in the municipal market. So, let's say in an ordinary year, you'd have $400 billion of new supply coming into the marketplace, right? Pretty orderly. You have that match up with how much money is coming in on the demand side. It's skewed to the other end during the pandemic. And so you have spreads going really, really tight for no reason whatsoever in the face of all these questionable credit questions, right? Like you pointed to MTA ridership. It's down still a good portion of where it was pre-pandemic, and we don't think that's ever coming back. However, spreads have tightened for MTA bonds.
How long can that continue? Because that dynamic is only going to last for so long.
It depends how long the state wants to keep subsidizing. And, bondholders are sort of the opinion right now that the state of New York is going to come in and keep supporting the MTA, and there's going to be federal money thrown at it. Almost it's too big to fail. And in many senses, it really is, because it's such an essential service provider for all the people who live in the New York City area.
Eric, 2022 is a brutal year across the fixed income spectrum, and that includes municipal bonds. Although munis did better on a relative basis, you've been clearly pointing out. How's 2023 been?
You know what? We started off with a bang. We headed into February with a bit of a whimper. We had one of the best Januaries as far as total return in the space, going back, probably over the last 30 years. And that sort of helped ease some of the pain that we saw last year. However, February has been kind of rough, and that really has been a function of what's going on in the Treasury market. So just to give you some context, 2.87% returns in January. We're down about 1% this month. Just to give you additional context, the worst February return over the last 10 years is about 1.5%. So if rates keep selling off, we could retest those lows.
What happens if the Fed keeps hiking and a little bit more aggressively or stays higher for longer? What does that mean for the muni market? Because, I could see how maybe that means higher yields. Maybe it's a better investment. But on the flip side, like lots of other stuff yield things. So maybe munis aren't as attractive.
Exactly. The angle that muni investors are really looking for is that relative value argument over treasuries. This ratio that we talk about like a bunch of times. And so what's going on now in the muni market is the ratios don't make a lot of sense for investors because the muni yields are really, 60, 70% of treasuries. You're better off buying the taxable option, treasuries or corporates, paying taxes on those rather than being in munis. You need these ratios to go higher. So it doesn't matter if the Fed keeps hiking. Munis really have to sell off in a really big way to bring those ratios back into an attractive range.
How are my municipal bond bankers doing on Wall Street? How is new issuance? How's it been? What's the forecast?
They're starving, Paul. You need to send them some help here. Yeah, primary supply is down 30% year over year. That's a pretty big gap, and I'm really unsure of how they're going to make that deficit up.
What munis may, in different areas, make good investments right now?
Well, all munis make good investments in the fact that their historical default rates.
Sure, but you're a muni analyst. You have to say that.
Of course I do. I'm completely biased. But the areas that we're seeing, I guess like spread opportunity in would be areas like bonds that are subject to the alternative minimum tax. They're sort of a play on tax availability, but they still have a good yield pickup over regular bonds that are just completely straight tax exempt. If you think the economy is sort of not going to roll over with the speed that it was projected before, there are opportunities there in healthcare and higher ed and sort of the lower rated entities that still make a lot of sense.
With higher interest rates, talk to us about kind of the funds flowing in or out of the municipal bond market. What are investors doing with their feet?
They're voting outward right now, which is also a head scratcher, right? ETFs had a huge year last year, not just for munis, but all across ETFs. But now we're seeing outflows over the last 4 or 5 weeks. And it's really a head scratcher because that low beta sort of option into munis had really been a winning play for a lot of the big fund complexes like BlackRock and Vanguard. And now they're leaking, assets out. It was one thing that you saw money coming out of the mutual funds that cost, 50, 45 basis points to manage your money. It was another thing when you see it leaking out of things that cost 5 or 6 basis points. So it means that investors are seeking out opportunities that make a lot more sense for them. And you can go back to what we just talked about with ratios to sort of explain a little bit of that.
So I just want to circle back and sort of end where we started, which was Connecticut, but then go south to Florida. If a lot of the bankers and hedge funds and private equity guys that are still getting paid a ton of money moved to Florida over the last couple of years, what does Floridian Muni market look like?
You know what? It's, again, surprisingly strong. given sort of the macro environment and sort of the economy as it is right now, weakening a little bit. But, Florida munis, they don't have a state income tax, right? So traditionally, the spreads on those aren't as tight as states as, say, New Jersey or New York or California, where there's just obviously more of a demand to shield income.
Interesting. It's like the other side of it.
Yes, exactly. All right, Eric, thank you very much for that. We appreciate it. Eric Kazatsky, he is the Bloomberg Intelligence Senior U.S. Municipal Strategist.
All right, coming up, how the fickle markets are driving down U.S. buy-side equity commissions.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide.
All right, now let's get to the U.S. equity trade. You got inflation, war, quantitative tightening, and just plain unease and uncertainty from 2022 are still taking a toll on U.S. equity commissions. So if you want to get into market structure and the inner workings of the stuff, Larry Tabb is kind of the only guy to talk to, Bloomberg Intelligence head of market structure research. Okay, Larry, talk to me about the environment for 2022 and 2023 so far and what that winds up meaning for commissions.
Well, this study is really more 2022, and for everybody breathing, 2022 is probably a pretty horrible year. And that was mainly true for a lot of the large institutional buy-side firms we interviewed and talked with about their trading, their equities business. Commissions were down 17.5% from 2021. And actually, there's some really interesting things that came out of that. Because of all the uncertainty and volatility and market downturn, a lot of the firms really tried to cut back their expenses, and because of that, we saw the services component of their wallet, actually becoming a lot more important than traditional. For the last, 18 years we've been doing this study. The top 2 or 3 services that the buy side's really looking for, are really more liquidity and trading oriented. And again, we're talking to traders, so it's not out of the ordinary for them to want better high-touch service, better algorithms, better analytics and services to help them manage, their execution. We also saw the commission wallet spreading out, meaning that they were concentrating less of their wallet with their top guys and moving it down towards, lower-tier brokers, which basically tells us that. And I think we can align that with the origination business, basically, just being terrible last year, that they were less worried about concentrating their wallet with 1 or 2 key origination partners to get IPO access, and willing to reallocate it last year towards a wider array of folks that would actually provide them research services. So it's just really interesting, how they look at their business, how they look at spending money, what's important to them, who they do business with, and why.
Is still the longer-term trend, Larry, that the buy side's trying to push down on the rates that they pay, the fees that they pay to the street?
We saw importance of lower commissions were actually more important with the larger players, which makes a lot of sense. They have a larger wallet. Performance is really more important to them. And so low commissions ranked actually pretty high. That said, last year we saw rates actually tick up, and that was really around trying to concentrate, as I said, flow with some of the larger brokers who are managing and have access to new origination. And a lot of the ways, whether we like it or not, the brokers allocate new IPOs to is the folks that pay them the most. Mm-hmm. And so we saw last year, or in 2021, firms actually vying to pay their brokers more. This year kind of reverted more on trend, where we saw commission rates drop, the wallet widen out a bit, trying to do more business with more regional brokers. This is another interesting thing. For years we've been asking them, okay, who do we think is going to succeed in the future? the last year or two, we've actually seen a resurgence towards smaller, and mid-tier type brokers. So they're looking to really differentiate their views, and get research, get services, get insight from a wider group of brokers. And it's really interesting that the sell side is saying that, they see the mid-tier guys gaining share just as readily as the bulge brackets. So very interesting change in views from buy-side traders. That is really interesting. Does that continue if we have more volatility and craziness in the market? Yeah, I think that does continue. I do think the number of brokers will widen out. The smaller brokers will wind up trying to offer, more keen insight, more differentiated views. The one interesting thing you see dichotomy here is that when you wind up with these large brokers, yes, they accumulate more flow and you can get access to better, in some cases, larger amounts of liquidity from these large players. But on the other hand, if you're trying to get research or services, the things that you're getting from one of these large guys is not only going to you, but going to, 1,000 of your competitors. Whereas if you're dealing with a mid-tier guy or you're dealing with a more niche guy who doesn't have the same distribution as a JPMC, let's say, you're going to get a more unique view or a view that's going to get acted on less than someone who has 1,000, 2,000, 3,000 clients. Hey, Larry, awesome stuff. Really appreciate Larry Tabb, Bloomberg Intelligence, head of market structure research.
All right, let's turn now to PayPal, which could deliver 10% revenue growth this year, nearly doubling the company's assumptions. For more, we welcome Bloomberg Intelligence senior financials analyst Diksha Gera. So where's the upside in the PayPal model, Diksha?
So I think two things. Firstly, everyone's aware that e-commerce had a good run and COVID kind of gave a bit of more much needed boost on that. But we are seeing some headwinds to discretionary spend and people are concerned. So is management that, costs need to come down. So their projections for their budgeting is of 5% revenue growth. But if you just look at the momentum that they've built, trying to match two sides of the ecosystem, which is both merchants and users via that PayPal and Venmo app, I think they're building quite a few competitive moats, and that's going to help them increase their volume growth. I'm assuming a 10-11% volume growth for the year, and that's what I'm basing my 10% revenue growth target on.
So what kind of areas can they expand in? Can you elaborate on that one?
So there are actually a lot of areas where PayPal is kind of really picking up the baton on. And there is a lot of concern around Apple Pay gaining market share or Cash App coming in and kind of targeting that core Venmo user base. But if you look at PayPal, it has been a leader. It still is a leader on global online payments. By online payments, I mean e-commerce payments on the web. And that is their anchor point to address and expand. So their user base is very committed. It's very loyal. And what they're trying to do is use that strength of online payments to provide them other services, including in-store services, including your digital wallets. And the same thing they're doing with merchants. So smaller merchants who were so comfortable with the security and the ubiquity and the ease of using a PayPal payment, they're trying to expand that and bringing in more enterprise-like features for those merchants and also providing them an omni-channel experience. So you can use a PayPal for an in-store payment, you can use it for your web-based payments, and you can use the same checkout process for your mobile payments.
It seems like, having partnerships across the retail ecosystem is key for these players here. Talk to us about PayPal, because they were, as you mentioned, one of the original players in the space. They certainly have great brand recognition. Talk to us about the partnerships they have and maybe some more that you're looking forward to.
Oh, yes, absolutely. So, PayPal is a name that every mom and pop knows. It's been around for a while. But if you think about it, all the smaller merchants who never had the convenience of enterprise features for taking payments, they all know PayPal, right? And PayPal is not sitting back on its laurels. It is aggressively going out and marketing with newer companies. It's partnering with the banks. You name the banks, JP Morgan, Bank of America, Capital One. It's partnering with the card network. So all the debit and credit cards are on there. It's partnering with the digital wallets, call it Apple Pay, Google Pay. So it's going ahead and engaging the entire ecosystem to make it more seamless and easy for you to handle any and every sort of payment on its platform.
Do these guys wind up just stealing customers from each other, or is the pie just that big that they can grow?
So there is a secular growth in digital payments, right? There is one common enemy. That's cash and that's check.
Oh.
So they are all...
You're killing Paul. He is a cash and check kind of guy.
Yep.
Yes, absolutely. So, I mean, if you look at the younger cohort that is so loyal to Venmo, you have that customer base. People argue that Cash App is kind of chipping away at some of that. But, I mean, let's not forget the fact that there are still a lot of people in the heartlands that still use cash. Mm-hmm. So all of these digital wallets on an aggregate are going to gain share still. And looking at that model itself, and there is, of course, like competitive intensity is increasing, but I still feel very confident about like them kind of being able to increase more share of volume. A lot of flows which were not digitized or capturable earlier are becoming more and more viable for these companies now.
Well, I can tell you that the pandemic, I'm sure the data shows, accelerated the penetration of digital payments, because even I use it so much more now than I did even a few years ago. But I look at the stock here, Diksha, the stock is up about 9% year to date. I look at the ANR function for analyst ratings, 37 buys, 14 holds, 1 sell. So it seems to be definitely a positive bias for this stock. What does this company need to do to move its stock higher over the next couple of years?
So I think the best thing that they're doing right now is not just sitting on their past wins, and they're aggressively updating their tech stack. I think that's something that is a very, very important thing to note, because a lot of large enterprises who had that success earlier on are losing to these incoming disruptors, aka your Squares and Blocks and the new companies, right? PayPal is not doing that. PayPal is running fast. It's building on both sides of the ecosystem. So that competitive moat is going to help them. The second thing is that they're using their strength to their advantage, right? Their ubiquity with the small, medium businesses, that's a very, very lucrative set of customers. They are going across channels with them. They've launched something called as a PayPal commercial platform, PPCP. And that platform basically allows all SMBs to kind of take payments across channels, and they're moving the new tech stack across through that platform. So that's one thing that will continue to let them benefit. So right now, maybe e-commerce discretionary spend will take a hit, as you know, a lot of economies kind of go through those macro headwinds. But once the market comes back, and we all know it will, we know that e-commerce is the way of the future, right? So at some point, we are going to see that secular growth come back in. And at that point in time, PayPal is ready to take on more and like scale much faster. So that's what we are looking for.
Before I let you go, what's something that PayPal's done that didn't work?
So I think that China piece is the stuff that I think it's kind of a wild card for them. And the reason I say that is because if you look at just the way China has expanded, it's almost 37% of global e-commerce market share. eBay was PayPal's predominant point in China. And then what happened across, I think 2021 is that they split ways with eBay. eBay found another partner called Payoneer, which is kind of helping them with selling to or letting Chinese merchants get paid in China. And we all know what Chinese merchants' presence in global e-commerce has become. If you look at Amazon, a lot of sellers are Chinese merchants. So if you don't have your China strategy in place, that is going to be a major blunder. So I think that's the leg that they really need to kind of fix and work on. And they wanted to introduce a cross-border wallet there. I checked with the company. They don't have much updates around that. I think that's the area which they really need to kind of get their act together on. The good thing is that ecosystem is still evolving. eBay lost its second leading position in global e-commerce to Alibaba. Then you have the Chinese entrants that are coming to the US. PayPal can be a great partner for them. So all is not lost, but I think that's the piece that I really want to see them do something about.
Diksha, great work. Diksha Gaurav joining us, Bloomberg Intelligence Senior Financials Analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.